Taking back America, one consumer at a time. It's the Krieger Files.
All right, 32 minutes after the hour, we're back here with Fred Dashevsky from U.S. Coin Capital, and that has a .com after it. U.S. Coin Capital, that's CAPITOL.com. And Fred Dashevsky is our go-to gold and silver guy. Good morning. Welcome back to the show, sir. And what's the skinny on gold and silver pricing these days?
Well, good morning, Dave. Good to be with you again. So, I have been impressed by the prices of both gold and silver. When we had talked in January, and we were under 3,000 on gold, and we were in the high 20s, $28 silver?
Yeah.
I was looking for mid to low 30s on silver by year end, and here we are in July, and we're at $37 silver today. So we cracked the mark. I didn't look in the last 30 minutes or so to see if it stayed up there, but it did cross that barrier. Gold is holding steadily. It's in the $3,300 and change range. And as the U.S. dollar has started to fade again, we seem to be substantially now in the below 100 on the dollar index. And we were at 104, 105 at the peak. So it's about 10% that we've lost on the dollar since the beginning of the year. And the expectations are this is going to get much worse on the second half of this year and into next year, which means weaker dollar, higher prices for both gold and silver. So if you think they're high now, wait till you see where we are by year end.
So the thing is that, the deals that we used to offer you now, because the market is so volatile, I mean, that would be a fair statement. It is volatile right now, right?
Oh, yes.
And so if the market's that volatile, that means that the premiums, where are they at? As far as, if you want to buy gold and silver, where are the premiums now? They're
the lowest that they've ever been in the 40 years I've been doing this. It's remarkable to me. So at the peak, we were $8.50 over spot per ounce on silver coins. So on a $0.50, that meant about $4 and change of its price was in that premium. On the quarters, it was $2.50 over spot for each quarter in their price. Now we are at minus $1 to the spot market. So the premiums are actually, fairly below melt, just a hair below melt on the costs now. And this is because as the price of silver has been climbing, they're trying to keep the price from going up, and they can't. So what they're doing is they're trying to squish the premiums that people can get for their coins in order to provide the same sort of end result, which is a lower price for the metals. But they're fighting a losing battle because the metals values are the fundamental inverse of the U.S. dollar. And no matter what Trump has done, the money that he's raised from tariffs notwithstanding, the dollar is still fading. And again, the problem is that the central banks have been loading up on gold. Most central banks that hold gold now have about 20% or more of their holdings in gold. That makes it a level tier one asset now. It's never been there before. Gold has always been used as a diversification by central banks. Now it is a major position in their holdings. And I think the public should look at their positions the same way. I mean, if the central banks are adding, there's a reason for that, and it's because they expect weaker currencies.
So 20%, they're saying, you just quoted, 20% of their holdings are in gold. And,
yes.
Folks, see, this is one of the reasons why I have Fred on the show. Because if you're sitting there and you're looking at where you're going to put your money and you're playing in the stock market right now and you're noticing, the S&P, NASDAQ, they're all volatile right now. And all Trump has to do is fart and the markets just go up and down crazy until he says something different. And then all of a sudden thank God, then see how it's almost like Trump is very good at manipulating the market unintentionally, because, they're not going to call him out on that, even if he is giving Jeffrey Epstein's son an alleged position in the government, and there's this big cover up and everybody's pointing a finger going, I told you so. They're trying to hide the fact. The thing is that it's a rope-a-dope for what's really going on in the economy. Because once you got people looking at something different, that's the old Sugar Ray Leonard thing, where you used to swing your arm around and you'd be watching that while he's punching you with the other one. And so, I'm looking at this going, okay, there's something going on with the economy. And now the Fed governors have finally come out and said, we're divided on the position of whether to lower interest rates. Why wouldn't they just go ahead and do it and help jumpstart the economy?
Well, I think they don't want to look foolish. So let's say they lower interest rates today. Yeah, all right. So let the obvious stand. But, they don't want to look like idiots and turn around and say, okay, we figured out that we need to lower interest rates, or that's what the pressure is for us to do. But what happens if a month from now we start getting inflation numbers that are higher than we anticipated, and then we end up having to reverse that process and raise them? That would look really foolish. It would look like they don't have any handle on what's happening in the economy. The problem for the Fed, of course, is it is fighting a dual-edged sword. One is it gets post-data. So most of the information the Fed gathers is after the fact. And it then has to look at it, divest that, and come up with some sort of conclusion as to what it leads to in the future, and then guess what would be the best move. So there is pressure to reduce interest rates because people like the idea lower interest rates would mean we could save $800-900 billion a year in the expenses of carrying the U.S. government's $36+ trillion in debt. The problem, though, is that if you overstimulate an economy, you can jumpstart an inflationary problem that would lead you then to have to raise interest rates. So the Fed is trying to not look foolish and jump the gun. And this is why there's a split in the governors. Some of them are saying, the hell with it. Let's just go ahead and lower the rates now. And, whatever happens, happens. If we have to raise them again in 6 months or 3 months, so be it. Others are saying we don't want to look foolish by moving in and out and coming up and down, so they rather would wait and hold on for a little bit more information. And this is the reason why the Fed is split.
But see, now I understand that there are all sorts of mortgage programs out there that basically can get you in at less of an interest rate. But they're trying to entice buyers, but buyers are sitting in the back seat saying, I'm not ready to buy a house until the interest rates come down. And so the markets are stagnating. They're overloaded with inventory. It's driving prices down. And the Fed is obviously aware of all of this. Would that be a fair statement?
Absolutely. Yeah, they're paying attention to everything. And again, trying to assess the best that they can. And the Fed is trying to maintain this distance from the overall economy, saying, we don't want to participate just to benefit one group or one side of the economy, even if that is real estate, which is a huge side of the economy. They are looking at an overall big picture issue. So I think rates now on mortgages were dipped below 7% again, if I'm right. I think I saw 6.75 at one point.
Right.
So that's really becoming very attractive again. And that should help, I think, the real estate market. If it's not low enough, the market will indicate that. And what will happen is, just like you're saying, there'll be a stagnation in sales. And if that persists for very long, something will give. People will either start lowering the prices they're asking, or there'll be a break in the interest rates to a point where we bring in those buyers again because they look at that money and say, oh, that's attractive. Now, I've always said this, and I've said this for 40 years. People who buy real estate are not buying a home. They're buying the money. Unless they're paying cash for the house, they are buying the money. So the cost of borrowing is everything. It doesn't matter whether the house is $10 million or $100,000. It's all about how much down and how much per month. That's all anybody really cares about. So if I could buy $1 billion house and finance it so that the payments were $1,000 a month for the next 500 years, so what? I'll be in debt for the next, 5 generations, but I'll own $1 billion house that I get to live in and play in for the meantime. So it's all about the interest rates, and that really is the key to the real estate market. So I know the people in the real estate industry are really paying attention and trying to splice all this stuff with the Fed. Imagine being in the position with the Fed. You're getting all this data, and I keep throwing at you economic data every day. Something else comes out. And then on top of that, you got Trump. Okay, Trump's like a wild card. He comes out of nowhere, and anything he says could be interpreted as, nonsense, gobbledygook coming out of his mouth, or serious. And it's hard to figure out how serious to take any one comment. But you've seen it, how the markets do. Yeah, this is where we get all this volatility, because it's really hard in the modern era. The old days when the president said something, it was a well thought out idea. He had his whole organization of people behind him. They thought about it. They'd had meetings. They'd come to a conclusion. And by the time they came forward and the mouth of the president opened, there was a clear, decisive decision. With Trump, every 10 minutes, it could be something completely different. How do you, as an economist, play into that hand? That's very, very difficult.
Well, let me say this. I think that we should just do a 50% tariff on copper.
It'd be beautiful.
Oh my gosh!
So it's like playing poker with a bunch of guys, but one guy gets to decide mid-hand that another card is going to be a wild card. So this is what Trump does. You know, he is that difficult to assess when it comes to economic decisions. I feel for the Fed. I really do. They have a really difficult position now and a tough time to try to figure out what to do. There's very little they could do that would be terribly wrong. In my opinion, they should take the leap, lower the interest rates now, and bear with it if it turns out it's a mistake and raise them again later. Who cares? Do you care if the Fed lowers rates and then raises them back in 3 months?
No, as long as I'm locked into a 4% deal, I'm okay with that. But, you know, like, I'm so glad, Fred, that you quantified and qualified this statement, because you're not borrowing on your home. You're borrowing money. You are. Right. This is the cost of borrowing money. So, in other words, folks, if you can live mortgage free and put your property in trust, you're better off, because now you got asset protection. To those people that aren't doing it, I just heard a horror story today about, you know, a guy that rear-ended a woman in Port Charlotte, Florida, and she deliberately was entering an intersection, slammed on her brakes, said he would hit her so that she could file an insurance claim. And there are people out there that, they get busted for insurance fraud all the time. But the thing is the guy didn't have that much insurance coverage on his car. And all of a sudden now she's gonna get that.
Sue him for the car.
And then sue him for everything else he owns, because none of it's protected. So, folks, this is one of the reasons why I have Brett on the show, because we get into the economics of stuff. And I got to wonder, if the government is hedging 20% of its wealth in gold, why isn't the rest of America following suit?
They should. And they should pay attention, because this is an expectation of weaker currencies. It means that nobody has got a plan figured out for how they can strengthen their internal currencies. You know, we talked about China, which is, again, a big export economy. So these tariffs are huge for them, the changes in them. And, of course, you know, if Trump is running tariffs 30%, 40%, 50%, so you're an importer, you send a product into the United States, it lands here, and I'm the guy buying it. Well, I now have to pay 50% more. You know, if it was $100,000, now it's $150,000 in cost to me. What am I going to do with that extra cost? Of course, I'm going to charge you, if you're going to buy that product from me, that extra money. So although the tariffs are paid by the importer, the person who accepts the product at the end of the line, it does get transferred over eventually to the consumer. So we are fighting that battle. And as these tariffs bounce up and down, eventually what should happen is a slower quantity of imports coming into the U.S., which means that this money coming in from tariffs will dry up. It's not a permanent situation. It's a temporary situation. So as people are saying, well, this is going to replace the income tax, we won't need to have income tax anymore because of the money we're collecting for tariffs. That's never going to happen. You know, there's no way that the tariff situation is going to support America indefinitely. We will see a lot of cash flow coming into us in the short term. This is creating some interesting market in volatility problems where we do get some money coming through. But if you look at how much the government is spending, even with what Doge tried to do, even with all the money coming in from the tariffs,
$300 billion,
still bleeding unbelievable amounts of money. In fact, at a faster pace, to the point where the expectations are we're going to add about $3 trillion more to the national debt over the next decade. And that, again, doesn't even presume interest rates going up. So I see this as a perpetual problem that has not been resolved by tariff issues, nor will tariff issues fix it. I think gold and silver are going to go a lot higher because the dollar is going to get a lot weaker. The central banks are taking a position that they believe they need that position strongly in gold. People should pay attention and follow suit.
Well, and that's the thing, too, folks. 1-800-878-2646 is the number to call for uscoincapital.com. I got it right up here. I know that number because I talk to Fred a lot, and we communicate, and this is the guy that you need to go to. I'm going to open the phone lines up, 717-300-1698. If you've got questions for Fred Dashevsky regarding a purchase of gold and silver coin. I know that a lot of you are scared about premiums and being overcharged. I've heard comments from people on that. From what you just said, Fred, you're saying you're in the minus on premiums. Could you elaborate on that?
Yeah, what I'm talking about is the cost to a dealer over spot to buy physical coins. Now, I've always assumed and believed logically somebody who had a manufacturer coin, mint it, you produce it, there's a cost in there. Refining the metal is expensive. Mining the metal is expensive. So we're always going to be paying more than the spot price. And again, the dealer also has to make a living. So there's going to be a price in there above the metal. But what has happened is that the premium used to also include an additional over spot premium to buy physical silver coins that, as I mentioned, has gone from a peak of $8.50 over the spot price to where it is now at minus $1 behind the spot price.
Wow.
So it just means I'm able to buy product a little cheaper than I used to be able to, and that means I can offer it at closer to its metal value than ever before. It makes it a great opportunity for people to accumulate. I've got a deal actually on two things today. One is 1,300 dimes, okay, 1,300 dimes for $4,100. We're talking about $3 and change per dime. That is an incredible price for physical silver dimes. I also have 1,500 half dollars for those that are a little bit more aggressive, $24,000. That is a 1,500 50-cent pieces, $16 a piece. They have about $14 in silver content. So the customer, with shipping, with everything, with my premium involved so I can make a living, they're buying the coin, they're paying $2 more than the pure metal that it's made of, not even accounting for anything, shipping, manufacturing costs, anything. That to me is remarkable. So I think there's a great buying opportunity for those that want to participate. And I think they should, because again, I'm very worried about those that don't own physical real estate or don't own physical assets that are way too heavily invested in all the paper worlds, because they're all subject to a lot of volatility. And that could go both ways. It could be up, it could be down. But I think as a way of diversifying, owning metals makes perfect sense, especially in this era.
Well, and you've got, we had another investor guru named Mark S. Kwan, or Mark J. Kwan, rather. You familiar with Mark Kwan?
No.
He advocates actually getting into debt up to here.
Okay.
And basically, because you can't take it with you. That's
right.
The whole bottom line. It's okay to be in debt, use it and leverage yourself. And I'm just like, the torment, because I've been mortgage free for a long time. And I can tell you what a great feeling that is, to not be beholden and have to look over my shoulder to worry about whether or not somebody's going to foreclose on me. And then I hear people going, oh, no, you should just not look at all the extra money you could apply to other things that you're doing if you would just get a mortgage. Well, if I do that, then I got to lien in my house and I'm always going to be looking over my shoulder. And I'm going to have a hard time getting to sleep at night because there's debt there. And some people just flat out hate debt. And yet we got a government, leadership by example, that likes to go out and just spend and kick the can down the road.
Back in the 90s, when my partner was alive, we had written a little thing. It was called Debt is a Blessing. And it was basically a conversation about exactly that. Is debt really a positive or negative thing? So the way we, of course, resolved this was, first of all, separated two types of debt. Things that appreciate in value and things that don't. So is debt good on a car? No, I don't think that makes sense. If
Mobile
you're borrowing
home.
money to buy a car, you're buying a depreciating asset and you're paying interest on the money. You're losing both ways. However, if you borrowed money to buy a house, theoretically, you're buying a piece of property that hopefully goes up in value over the years, an appreciating asset. It's not a bad idea to use capital and take on debt to buy an appreciating asset. And, if you look at the history of the Rothschilds, the Rockefellers, the Lehmans, the Shearsons, the way these guys leveraged their money is they borrowed every cent they could get and went into debt, like you said, up to your eyeballs, and utilized that capital to try to gain more capital revenue or assets. Asset accumulation was the key. If they could borrow money, go into debt and buy a company, and that company produced, revenue and capital, it made sense. So there is that balance point, but a lot of it comes down to personal comfort. I paid my mortgage off 20 years ago on my house. It's just something I did. In retrospect, I don't look back and say, I'm sorry I did it, but I do also understand that I have an opportunity to strip the equity out of my home and use that to move forward and do other things. The problem is that, it has to be something that would be really secure and stable. And how many things are secure and stable that will pay you interest more than what it's going to cost you to borrow the money? And therein lies the rub. Can you get a CD and guarantee that you'll get your 4% a year? Yes. But how much money is it going to cost you to borrow the money to buy the CD. Well, that won't work then. If it costs you 5% or 6% to borrow the money, making 4% is a losing proposition. But if you could borrow at 7% and earn 10, well, okay, then you're making headway. But a lot of people do have that personal kind of gut feeling. Some are okay with the idea of carrying the debt long term, and some, like yourself, would rather say, I like being debt free. I like the no weight on my shoulders. I like the no third-party obligations. And with all this, forgive me, bullshit going on in the real estate market, I can understand the concerns of what could go wrong if you suddenly find yourself not owning your home because you're obligated on a mortgage, and the banking industry goes, gazooey, and the next thing you know, we're experiencing all sorts of problems as homeowners.
Well, and understand, too, mobile homes are a bad investment, too. And I hate to say it, but that is the housing of last resort for a lot of people in America right now, because literally that's all they can afford. I'm sorry, folks, but that mobile home is high maintenance. I mean, that's worse than a blonde American princess, if you get my drift. I mean, you literally are going to have to be putting tons of money into that thing and fixing it up, putting it on a permanent foundation. I mean, there's all sorts of things, and people are going to look at it and going, right? Yeah, I don't want to manufacture a home. And I mean, look at the chemicals that go into this stuff. A lot of it is pressed particle board, and it's toxic. So I'm telling you that manufactured housing is not it. This is why I got into the steel SIP business, because of the fact that you got 2 sheets of steel with EPS foam in the middle. It's termite proof. It's hurricane category 5 resistant. And this is one of the reasons why I advocate for it, because you can do that for about the same price as you could build a mobile home and then fix it up yourself.
This is one of the reasons I've always loved gold and silver, is that you can own it physically. There's no maintenance. There's nothing that requires anything that needs to be repaired. No windows get broken. No sewers need to be fixed. You don't have property taxes on it. There's nothing that can go wrong. You own it outright, and you have possession of it. So if you'd have borrowed $500,000 January 1st and paid 7% on the money and put all of that money into silver, you'd have about a 25% gain right now after the interest payments on the loan. It would have been a very successful venture. So in some cases, this can really work out. But I've always favored gold and silver because it is maintenance free. It's one of those things you can own without any headaches. You put it away in your safe deposit box or your vault and lock it up and just forget about it. And, look at it years later and boom, see what happens.
This is one of the peace dollars. I know you can't see this, folks, but this is one of the, it's a 1923 AU peace dollar, and I've got a whole roll of them right here, whole stack of them. I put in a nice silver case right there. You can see it. And these are all 0.90%. Is that right?
Well, they're 0.90 silver, but it's 0.77 ounces of pure in each one.
Right. And so where are we at on silver dollars these days, price-wise, Fred?
Well, silver dollars have the higher premium than the quarters, dimes, and halves. So right now you can buy silver dollars at around $36 or $37. And again, with the price of silver being about $36 an ounce, but again, you're talking about 0.77 ounces of pure silver in a silver dollar. So the melt value is going to be around, what is that, $26 in pure silver, and you're buying it for around $36. So about $10 over melt value for silver dollar. But
right.
Again, that's because silver dollars ended in 1935, not 64 like the dimes, quarters, and halves.
Right.
And fewer silver dollars were minted than dimes, quarters, and halves. So they realistically have a higher premium. Just seems like it's a great opportunity, because not only can we get more silver for the same amount of money, but we can take advantage of what I believe to be a temporary reduced premium situation. I think this will reverse and be back at points where we're paying way over spot again as the availability of these things continues to dry up. Because remember, they can't go back to 1964 now that there's more people waking up and saying, well, shit, I need to own some quarters and dimes, and there aren't any more being made. We only have what's out there in the world. 10 years from now, 20 years from now, there will never be any more of these things than exist today. So the idea of owning them physically and having that in your possession is huge. And with these low premiums, they really do represent a great buying opportunity. I always try to find for your listeners, things that would make sense today. So silver dollars still make perfect sense to me. But if somebody said to me, I've got $20,000 to spend, what specifically would you recommend? I would take advantage of the 50-cent quarter dime low premium and recommend that right now over the silver dollars.
Sounds like a winner. 1-800-878-2646 is the number to call. And it's U.S. Coin Capital. KFOL.com. Fred Dashevsky, it's always a pleasure having you on the show. And, we like to talk about the economy and where things sit right now, but we are out of time. Folks, we'll be back tomorrow. More interesting news and conversation with you. In the meantime, God bless you and God bless the United States of America. What's left of it.